financial statements, something that may be overwhelming at first, but it is important to understand the financials when you're investing in companies. So in this video, I go at a high level in a Tik Tok compilation, showing you exactly what each of the three main financial statements are: the balance sheet, the income statement, as well as the statement of cash flows. If you look at that strong balance sheet, if you're new to investing or you follow my channel, you may have heard me talk about a strong balance sheet. And if you didn't take accounting courses like I did in college, you'd have no idea what the hell I'm talking about. I know, I'm a nerd. But with any luck, I can turn you guys into finance nerds too. A balance sheet is a financial statement that most investors will take a look at. It's really just a snapshot in time of where the company's assets and liabilities are at. Just remember this formula: assets equals liabilities plus owner's equity. So as long as that equation holds true, the accountants are happy. So let's look at Facebook's balance sheet from their latest 2019 10K. Assets are the resources that the company owns. You have things like cash. It's good to have a lot of cash. You have marketable securities, meaning those are short-term investments that can be turned into cash. And you have accounts receivable. That's things that people owe the company that can be turned to cash later. And you also have things like property and equipment. Then you have liabilities. Those are things that the company owes. Accounts payable is how much they owe other people. Companies also have things like debt in order to operate or make large purchases. We'll cover the rest in part two. Part two of balance sheets. Below the liabilities, you have stockholders' equity. This includes such things as the sale of shares from an IPO, as well as retained earnings from prior periods, so accumulated retained earnings. The best way to think about retained earnings is you start with the net income and then you subtract the dividends that are paid out to shareholders, and that's the retained earnings. You can have prior period retained earnings stay there, and this money is basically capital that's sitting on the balance sheet that can be used by the company to make further investments and get future returns. But back to the original question, what makes a strong balance sheet? In a perfect world, you really want a lot of assets and a small amount of liabilities. But in the real world, you usually need debt in order to operate your business. So here are some metrics that you can use to analyze a balance sheet. The current ratio measures liquidity, so it's just current assets divided by current liabilities. Or you can look at the debt to equity ratio. A lower debt to equity ratio is good because that means that you own more than you owe as a company. Make sure to like and follow if you learn something new. When it comes to investing in stocks, you want to invest in companies that are making money, right? Tesla. Let's go ahead and talk about something called the income statement. At a high level, the income statement is really just taking all the money that the company is making and then subtracting all the company that has to pay out, and what you're left with is net income. Let's break down the specific components. So we're taking a look at the 10K for Facebook, and you can see this first line item is revenue. Revenue is just another word for total sales. So when a company pays for advertising through Facebook, that is revenue to Facebook. But in order to run the business, you have to have costs as well. So there's costs and expenses. There's cost of revenue, which in this case is mostly employees. You have all the infrastructure of Facebook, research and development, all the money that goes into testing and developing new products. Marketing and sales, so all the advertising that you have to do for your own company and obviously paying the sales team. And then overheads like general administrative. That leaves you with the income from operations. Then there's income from interest, such as short-term investments. And then you got pay taxes, and you're left with net income. Make a part two for metrics. Welcome back to part two of the income statement. Bless your finance nerd heart. In part one, we talked about how to get to the net income. Net income really shows how well your business is able to turn sales into net profit. And obviously the goal of all businesses is to increase that net profit over time. What do businesses do with that net profit? The company can turn around and give that profit back to the shareholders in the form of a cash payment known as a dividend. You can also use those profits to reinvest back into the business and continue to grow that bottom line and continue to grow that net income for future quarters and future years. So what are some of the metrics I use to look at an income statement? One thing I focus on is how efficient is the company for turning the sales into profit. So operating margin would be the income from operations divided by the sales. Your profit margin is your net income divided by sales. This metric shows you for every dollar of increased sales, how much is going to go to the bottom line, aka how much money are you going to make. And it looks to be around 26% for Facebook. Anything over 20 is pretty good. Show me the money or show me the cash is what you should be saying when you're looking at a company's financial statements. And there just so happens to be one of the financial statements is known as the statement of cash flows. This statement allows investors to see how well a company is managing their cash position in terms of paying debt obligations as well as funding operating expenses. Because when you look at a figure like net income, it doesn't necessarily mean that revenue minus expenses equals how much cash the business made.
Another way to think about the statement of cash flows is it's tracking the ins and outs of the cash in the business throughout a period of time. So let's say you ended the year with $10,000 worth of cash, and then after a year, you ended up with $20,000 of cash. You're measuring that $10,000 increase through operations, through investing, and financing. So with the financing section, at a high level, it would be such things as taking out a loan, you'd increase the cash. If you pay down debt, that's decreasing your cash. Or if you pay out dividends, that lowers your cash.
Make a part 2 to cover the rest.
Welcome back to part 2 of the statement of cash flows. And the section we're talking about is investing. So this includes things like buying property or buying equipment to run the business. That would lower your cash position. And then you can also buy shares of other companies, and if you sold that stock, that would increase your cash position. Then you have cash from the operation. So let's say you had an accounts receivable, that's people owing you money, and you collected on that. So now your cash went up. Or you have liabilities to other companies and you owe people money and you pay that down, your cash position will go down. Or if your business has inventory and you bought inventory, your cash position would go down.
Once you have all this broken out, hopefully you're making most of your cash from the operating activities. Usually the operating activities is an inflow of cash, and then investing as well as financing would be an outflow of cash. I said usually. Another important metric that investors look at is the levered free cash flow, which really looks at how much money is left over after paying for debt obligations, capex, and operating expenses. This can be used to expand. This can be used to pay dividends. Hope you guys learned something today in the video, and if you do enjoy this kind of content, make sure to like and subscribe for more. Thanks guys, and have a great day.